Hey guys, welcome to Tixie Magic Scheme, where we try to turn our hindsight into your foresight. So you want to buy a house. Hey guys, so when it comes to buying a house, especially for a mortgage, there's three things to essentially look out for and understand. There's obviously more, and we'll make a more in-depth video, but this is just for you to understand. Now, so one is your deposit, which the hardest barrier to entry for buying a home is your deposit for most people, which is why the Help to Buy ISA was created and why the Lifetime ISA was also created, which go and check out our videos on the Help to Buy ISA and the Lifetime ISA for you guys to understand what that is. Obviously, Help to Buy ISA is closed now, but if you've already opened yours to understand it more, whereas a Lifetime ISA, you can go and understand that a bit more, and we'll be dropping more gems later on. So the deposit is your biggest obstacle. Obviously, most people end up trying to save up to at least 10% of the property. I think the national average on first-time buyers is 16% right now, saved towards the home. So if it's a 100k home, most people save up to 16k. Obviously, when you're saving for your mortgage, also think about saving for your lawyer fees, conveyancer, solicitor, agent fees, possible stamp duty, product fees, all these kind of things. So basically, save about 3 to 5k extra on top of what you've been saving for a house. So don't think I'm gonna save my deposit and that's it. Now, two, we're gonna talk about your credit rating. Now, your credit score needs to be on point when it comes towards buying, not just buying a house, but securing a mortgage. So you want to make sure that your credit score is healthy and it's good and it's not playing around. So go check out our video about credit scores and credit agencies as well, because we go into more depth onto your different credit scores into them. Now, with your credit score and your credit history, you need to start establishing it, because essentially when it comes to a mortgage, they're very they scrutinize you very much in terms of like your finances and stuff like that, in terms of what have you done in the last 6 months, etc. So if you're planning on buying a home or getting a mortgage anytime soon, if you're planning on getting it in about 8 months time, don't go and get a new phone contract, car on finance. Don't go get, don't do a lot of stuff that will mess up with your credit. So essentially, it's not, people say 6 months, but the reason why I say 8 months is because sometimes it can take up to 6 weeks to 2 months before it actually reflects on your credit score / your credit report that you've now got a new phone, or you've got a new direct debit. All of that goes onto your credit report, which the banks see. So they normally say 6 months. You want to get your budget in order, you want to have the money. So if you say you're spending this, when you go to the mortgage calculator, if you say you're spending £200 per month on this cost, you want to make sure 6 months before you actually get to there, it's actually only £200 that is going out there, because they will actually scrutinize you. The reason why they scrutinize is because when you're going into buying your own residential property, it's not like it's different. So when they scrutinize, they don't scrutinize as much when you're doing a buy to let, because you're buying for property reasons. So you're buying to make money, and your house is supposed to be rented out. So the house is what's the money maker. So they just look at whether it's a good house. You get what I'm trying to say? So it doesn't really matter about your credit score when it goes to buy to let, because if the house is good and it's going to rent out for £500 to 4 rooms, that's 2k, and the mortgage is £600, the banks can't, they'll give you the money. Whereas when it comes to a residential home, it's you that's paying, so they have to trust you, and they have to make sure that you can do this and that you can afford to do this. Now, this leads me into the third thing that they look into, which is an affordability check. Now, the affordability check is basically like, how much are you making, as opposed to how much house are you trying to go for. Now, the loan you get from, so a mortgage is a loan used to buy a house. That's simply what it is. It's a loan not just to buy a house, but secure to a house. So if you miss your payments too much, then they'll take the house, basically. And when it comes to affordability check, it's normally about 4 to 5 times your gross yearly income. So even if you save 20k in deposit, you've been saving for time, even if you save 20k, if your income even from other sources, isn't that high enough, then there's a likelihood that even if you save 20k for a 100k house, but you're only making 10k per year, then they would likely decline you. So when the affordability isn't about how much the house is worth, it's how much you're trying to borrow. So if you save 50k and the house is 250, now let's say you're making 40k, there's a chance that since the amount you're trying to borrow after 250k of house is 200k, then the affordability check is for the 200k because you have 50k of equity. To explain equity quickly, equity is just essentially how much money in the house or how much stake within the house you actually own. So if we had a pizza and I brought a pizza was 10, the pizza was, I don't know, yeah, let's go like this. The pizza was £12 and it had 12 slices. I brought £8 and my brother brought £4. So my brother owns 4 slices, I own 8 slices. I'm the bank, I gave him my £8. I said, hold my 8 slices, just pay me back later. Whereas he brought £4, which is his deposit, which means he has 4 slices in there as equity. Now next month he pays me £1, so that means he now owns £5 in terms of 5 slices, and I still technically he owes me on 7 slices, if that makes sense. So that's how equity works, and that's how it goes in terms of repaying your mortgage. So guys, that's just a brief understanding of what it takes when it goes to buying your home. So your deposit, start saving now. 2, your credit score / credit history / credit report, and a lot of different things. So the score is just a number and the indication whether you're going to be accepted or not. The report is what they give to you every month, every 30 days on a cycle, saying this is how your thing has changed, and your credit history is essentially over time. What have you done? Have you missed payments? That's really, don't ever miss a payment because that will really come up on your credit score. And your credit history, sorry. Ooh, so many terms. And your third thing is affordability. So I've known people who have been making 50k for the past 10 years and they're struggling to get a mortgage on a 400k home. So he had to do it with his wife just to be able to get it. So it's really that simple / that hard. And yeah, guys, so that's just a little intro into understanding what it takes when you're trying to get a home. There's obviously other stuff you need to look out for, like house integrity testing and all these things, but we'll educate you guys about that later. Start with the saving. Thank you very much for being with us. Have a blessed day. Keep on smiling. Bye.